Kyle, can you explain real quick why dynamic banking is better than putting all your money in the stock market, and make sure you take it out and buy the dips if it ever crash? You can do dynamic banking and put your money in the stock market. In fact, it allows you to put more money in the stock market a little bit quicker. Because what we do when we do dynamic banking is we take a line of credit. So we're borrowing. The first thing we're doing is we borrow someone else's money. We borrow someone else's money and we pay down a debt, or we make an investment with it. And in this case, you're talking about the stock market. So you could take a chunk out of that line of credit and put that into the stock market. Start earning right away. I'm assuming if you're going to do something like that, that you have a plan, a mostly foolproof plan to make some profits off of it. Or at least you don't really have to. If you're at a point where investing is your main goal, that's not really that big of a deal. But once you do that, so rather than your income putting a little bit at a time into the stock market, you got to put that whole big chunk in right away. And then your paycheck, all of your paycheck goes into the line of credit, offsets those interest charges. So you're using someone else's money and you're only paying a little tiny bit of interest on it until you start paying your bills off. And as you pay your bills off, the amount of interest goes up because your balance is going up. But a line of credit works to where you only pay on what you're borrowing that day. It's your average daily balance, what you get charged for interest. So by putting your whole paycheck into the line of credit, you're reducing that average daily balance. Meanwhile, in the stock market, you've got all of those funds working for you in there. So Kyle says, like, actively manage your portfolio. And dynamic banking is good if you don't need a line of credit. Why do you take a line of credit in the first place? The reason to take the line of credit in the first place is so that you can use other people's money for free. That's the whole point of it. Otherwise, you're waiting for your income to come in before you can start using it. In this case, we want to use somebody else's money. And then when our money comes in, we get to work it down. We're going to offset those interest charges. Where do you get a line of credit? You can get a line of credit at a credit union or a bank. Those are two places that most people try to get a line of credit. And you can get a line of credit for yourself. You can get a line of credit for your business. You can get a home equity line of credit or a personal line of credit or a business line of credit. Those are basically the three main types of lines of credit. I love lines of credit. Lines of credit allow you to put your money to work for you wherever you need it to, and it helps to provide you with a little bit of emergency funds if needed. So you can basically not have to carry so much cash. You don't have to carry so much cash. You don't have to have a home to get a line of credit. You would have to have a home to get a home equity line of credit. But you can get a personal line of credit or a business line of credit. I hope you found value in today's video. If you'd like to find out more about IUL and whole life, check out these videos right over here. And we'll see you next time. Now go maximize your cash flow.